The last time the world saw an economic shift this massive, most regular people completely missed the boat, and the tiny group that did not ended up becoming absolute millionaires right now. In the middle of 2026, something massive is happening under the hood of the global economy that is going to define the next 20 years of your personal wealth. And I am not talking about the next decade. I am talking about the next full 20 years of your life. I am not just talking about one single trend either, because what we are looking at is a violent collision, a massive pileup of global economic forces that have never ever happened at the exact same time in modern financial history. The stock market, physical gold, global trade networks, advanced artificial intelligence, and the global dominance of the US dollar are all moving in ways that university textbooks do not even have a single chapter written for yet. The absolute scariest part of this entire situation is that most ordinary people are not paying a single shred of attention to the data. So that is exactly what we are diving into today, with absolutely zero fluff, just the cold hard facts, the precise data points, and exactly what every single bit of this madness means for your hard-earned money. Make sure you stay all the way until the very end of this video, smash that like button, and let us get straight into the numbers. Here's the fundamental problem with the average person. Most people watch the daily news, see flashing red numbers on their smartphone screen, and instantly feel physically sick. Or they open up their investment account, see a bunch of green numbers, and suddenly feel like an absolute financial genius. That is the entire extent of their financial awareness. And they just react emotionally to sensational headlines without ever zooming out far enough to see the structural shifts actually occurring in the macro environment. I completely get it. Because the mainstream headlines are meticulously designed to terrify you or make you insanely excited, since that is exactly how media companies get clicks and ad revenue. But let me show you what is actually happening underneath all of that superficial noise, because what is going on underneath is 10 times more important than any single headline you will read this week. Let me ask you a direct question. Do you actually know what happened on the 28th of January 2026? Because that was a historic moment on that exact day. The S&P 500 index crossed over the 7,000 points milestone for the first time in human history. To put that into perspective, this is a stock index that took nearly 3 full years just to grind its way from 4,000 points up to 5,000 points. Then it absolutely accelerated, flying from 5,000 points to 6,000 points in just 9 short months. After that, it rocketed from 6,000 points straight to 7,000 points in only 14 months. The sheer speed of this market expansion is something we have genuinely never witnessed before in the history of capital markets. But here's the critical thing I need you to keep in the front of your mind as I walk you through all the data today. This massive number, 7,000, is absolutely not a celebration for everyone in the economy. In fact, for most people watching this video right now, that historic milestone means absolutely zero if your personal portfolio is not set up correctly to capture it. Being set up correctly is exactly why I am making this video, because right now we are not just living through a standard cyclical bull market, we are living through a massive moment of global history. The next 10 to 15 years of your financial life will be entirely shaped by the specific decisions you make right now in 2026. Let us break this whole situation down piece by piece so you can actually understand the gears running the machine. Let us start directly with the S&P 500 and the real reasons why it is performing these crazy market moves. That historic milestone back on the 28th of January was not some random stroke of luck or a temporary market anomaly. It happened because of one massive catalyst that sits above everything else, which is the commercialization of artificial intelligence. I am not talking about the speculative, overhyped version of AI that you have been hearing tech influencers babble about for the last few years on social media. I am talking about the real institutional money-making earnings generating version of artificial intelligence that is fundamentally changing what major global corporations are actually worth on paper. Just look directly at the corporate financial data. Microsoft, right before the massive 7,000-point market breakthrough happened, officially reported a staggering $281 billion backlog in AI-related service contracts. We are not talking about future dreams or hypothetical sales projections. We are talking about actual signed contracts with enterprise clients and actual corporate money locked into their ecosystem. Then you look at Meta, which announced they are spending more than $115 billion in the single year of 2026 alone, just to build out their internal AI infrastructure and data centers. The 4 absolute biggest tech companies on the face of the earth, which are Alphabet, Amazon, Meta, and Microsoft, are collectively on track to spend an astronomical $505 billion on physical AI infrastructure just in this single calendar year. Now, take a second to think deeply about what that level of corporate spending actually means for the broader economy. That is not money magically disappearing into a black hole, because that massive ocean of capital has to flow directly into someone else. As balance sheet, it flows directly into advanced semiconductors, into massive physical data centers, and into the specific industrial companies building the actual physical machinery of the AI era. NVIDIA famously crossed the $5 trillion market cap milestone back in 2025, while companies like Broadcom, Micron, and ASML are all experiencing historic, unprecedented demand for their technology. This is a massive capital infrastructure spending cycle, unlike anything humanity has seen since the interstate highway system was being constructed across America. Except this time around, the entire build-out is happening over a span of a few years instead of stretching across multiple decades. Because of this massive surge, institutional analysts at Goldman Sachs have already raised their official year-end 2026 target for the S&P 500 all the way up to 7,600 points. JP Morgan has put out an official bull case scenario pointing toward 8,000 points if the macro variables play out correctly. These are not small, speculative numbers being thrown around by random people online, but wait a minute, here is the exact thing I need you to understand deeply. Before you go and dump all your cash into the market, the S&P 500 hitting 7,000 points does not automatically mean that every single part of the underlying stock market is fundamentally healthy. It does not mean your hard-earned money is completely safe just because the broad index number is going up. Because right now in 2026, we are dealing with what institutional analysts are calling a deeply split K-shaped market. On one single side of the fence, you have mega-cap tech, AI infrastructure, and semiconductor designers absolutely printing billions of dollars in free cash flow. On the completely opposite side of the fence, you have major healthcare companies getting absolutely crushed by policy shifts, traditional consumer brands dealing with massive tariff headwinds, and commercial real estate firms desperately struggling to refinance their massive debt loads at higher interest rates. Look at the individual corporate reports. Nike recently suffered over $1 billion direct financial headwind, specifically due to newly imposed trade tariffs. Procter & Gamble was forced to aggressively raise retail prices on 25% of its entire product catalog just to offset a $1 billion annual tariff impact on their supply chain. United Health stock violently dropped nearly 20% in a single trading session due to regulatory shifts and rising medical costs. So while the broad stock index looks amazing because it is up, the index itself is no longer representative of the average company. This extreme divergence is exactly what makes the year 2026 so incredibly complicated and so vital for you to understand if you want to protect your capital. Oh, and by the way, I just opened up my completely free financial community where I show people how to open a YouTube channel from absolute zero and survive this economic volatility. So the link is right below. Now let us pivot and talk directly about tariffs, because this trade war landscape is where things get genuinely wild for business bottom lines. The current trade war policies have marked the most significant radical shift in United States trade policy since the year 1993. Think deeply about that timeline. We are talking about a shift that breaks a 3-decade trend of globalism. The Non-Partisan Tax Foundation officially estimated that these aggressive tariffs amount to an average direct tax increase of $1,500 per single United States household in the year 2026. Just last year, that average household burden was sitting at $1,000, and now it has jumped straight up to $1,500. And that number is continuing to climb as supply chains fracture. Then, on the 20th of February 2026, something absolutely massive happened in the legal system. The United States Supreme Court handed down a historic 6-3 ruling declaring that the International Emergency Economic Powers Act, which was the foundational legal tool being utilized to impose sweeping tariffs on almost every single global trading partner, does not actually authorize those broad tariffs. This single legal decision immediately and violently changed the entire economic landscape overnight. The broad emergency tariffs instantly collapsed, leaving only the specific Section 232 tariffs, which cover heavy industrial sectors like steel and aluminum, fully intact. Now, does that historic Supreme Court ruling mean the global trade war is completely over? Absolutely not. The administration responded almost immediately by leveraging alternative legal mechanisms to slap a 10% universal tariff across the board. But the court ruling effectively removed the most aggressive, unpredictable pieces of the macro tariff structure. Meanwhile, China did not just sit back. They hit back hard with massive 34% retaliatory tariffs of their own, alongside strict export controls on critical raw materials. These measures are meticulously designed to place severe operational pressure on American businesses that remain deeply dependent on Chinese manufacturing components. This geopolitical trade tension is absolutely not going away anytime soon, and pharmaceutical tariffs are projected to potentially skyrocket to 200% by the late months of 2026, while consumer electronics remain stuck in a massive regulatory gray zone. Here's exactly what this means for you as an investor and for the broader global economy. Major automotive companies like GM, Ford, and Toyota have all officially initiated massive reshoring initiatives. They are actively spending billions to move their physical production lines back inside the borders of the United States to completely avoid these punishing border costs. GM already had to pay a staggering $3.1 billion in direct tariff costs in 2025 alone, while Toyota and Honda are both making public announcements regarding massive capital investments to increase their domestic U.S.-based manufacturing footprint. This is a massive structural shift in how global supply chains are built from the ground up. A shift of this magnitude takes multiple years of physical construction to complete. During those transition years, you get immense economic friction, higher corporate operational costs, and massive market uncertainty. At the exact same time, look at what the central bank is doing. The Federal Reserve cut interest rates 3 separate times in the late months of 2025, which brought the federal funds rate down into a target range of between 3.5% and 3.75%. The broader capital markets are actively pricing in even more interest rate cuts as we move through 2026. Lower interest rates inherently reduce the cost of corporate borrowing, which acts as direct monetary fuel for business investment and stock market growth. But on the flip side, you have these aggressive trade tariffs actively pushing consumer prices higher. So on one hand, you have the Federal Reserve trying to support the broad economy by cutting interest rates. And on the other hand, you have national trade policy making physical goods more expensive for companies and consumers. These two powerful macroeconomic forces are pulling the economy in completely opposite directions. And learning how to navigate that structural tension is genuinely one of the hardest challenges for any investor today. Now, I want to dive deep into an asset class that I strongly believe is the most completely underappreciated and misunderstood part of the current economic picture. And that asset is physical gold. Gold right now is putting up a performance that it has almost never achieved in the entire history of modern markets. Let us look directly at the raw numbers. Gold closed out the year 2025 up roughly 60% in value, a 60% gain in a single calendar year for a massive global safe haven asset. The last time gold put up a performance that explosive was all the way back in the high inflation era of 1979. Before 2025, gold had never passed $3,000 an ounce. Then it smashed through $3,000. Then it blasted past $4,000. And in early January of 2026, it briefly touched an insane high of over $5,600 per ounce by April of 2026. The price has stabilized around $4,750 to $4,850 an ounce, even after a standard healthy pullback from that historic peak. JP Morgan is currently forecasting that gold will average $5,055 per ounce by the final quarter of 2026, and their longer-term institutional models point towards $6,000 an ounce as a highly realistic probability. Now, why on earth is this happening to a boring old metal? It is happening because there are multiple independent macro forces all pushing the asset in the exact same direction at the exact same time. First, global central banks are buying up physical gold bullion at a record-breaking pace. We are talking about over 700 metric tons of physical gold purchased in just the last 12 months by central banks, primarily driven by emerging market nations like China, Turkey, India, and the wealthy Gulf states. These sovereign nations are quietly, steadily, and systematically moving their national reserve money out of U.S. Treasury bonds and directly into physical gold bars stored in their own vaults. The U.S. dollar's total share of global currency reserves fell from a high of 71% back in 1999 down to around 56 to 57% by the end of 2025. That is a massive historic macroeconomic shift. Sovereign nations are actively diversifying their national wealth away from the dollar system, and gold is their destination. Second, the structural value of the US dollar itself has been weakening against baskets of real-world goods. And a weaker fiat currency naturally makes gold cheaper for foreign buyers using alternative currencies, which